presentation contains current opinions of Moe Sansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello, everyone, and welcome to the Compak Asset Management YouTube update. I'm Mo Ansari, and I'm doing this on the 27th of July, a little bit later than I usually do this. I waited until we got the Fed meeting out of the way today, and they raised interest rates by 25 basis points as expected. So I think that is going to have an impact on the market. It did have an impact, and let's go and take a look. I'm going to talk a little about the Fed this week. Is this a bear market rally, or is this the beginning of a new market rally? I'll talk about that. The economy, where we are, technical analysis, market meter, and the week ahead. This week, as I mentioned last week, is going to be the critical week. We have a lot of data coming out. We had the Fed meeting this week. Now we've got the GDP numbers coming out. We had the earnings coming out. We had Microsoft and Google yesterday. We had Meta and a number of other companies come out today. And overall, they're not bad. Earnings, we saw Microsoft and Google soar today, even though their numbers were a little bit lighter. Why did they go up? Let's take a look. Let's first talk about the Fed. The expectation was that they were going to raise by 0.75, which they did. But one few things that they mentioned, they raised by 0.75%, the interest rate. And what they said is we've reached neutral already. And now what Paul said today, that we might raise it a little bit more, depending on data. And as I mentioned on the daily radio broadcast that you can tune into every day, all you have to do is go to Market Wrap with Mo Ansari. Type that. I know it's a long word, but type all of that into the Apple Store. Market Wrap. That's WRAP with Mo Ansari. Type that in, and you will get. You can download the free app, and you'll get the daily broadcast that I do every day. 1 hour broadcast, great guests from around the world. And I've been talking about that I said that they're going to raise interest rates by 0.75%. Well, what they say is going to have a bigger impact on what Mr. Powell says at the press conference. What he said is, we've reached neutral. So now he wants to tighten interest rates or tighten financial conditions. Well, they're already doing that when they're taking $95 billion out of the economy every month. That is with the bonds that they're holding and maturing, they're not replacing them. So they used to put 95 billion back because as the bonds matured, they bought new bonds, so they put cash in and took the bonds on their balance sheet. Now, as those bonds mature, the bonds go mature, they go off their balance sheet, but they're not taking that 95 billion that they get and put that back to buy new bonds. So that is going to continue. I think the Fed will continue to raise interest rates. The market is euphoric. Today, we had a big day on the upside. But I think, again, just like 2 weeks ago when we had the CPI numbers come out higher than expected at 9.1, everybody ran to one side and the Fed could raise interest rates by 1% in July. They didn't. What I talked about at that time was we could see rates going up by 0.75. That's what they did now. Now what they do next, I think, will depend on the next inflation data that we get in August, in September, the unemployment data. And one thing that I've mentioned all along is the unemployment rate has to start going up. And Mr. Powell was asked, are we in a recession? Well, technically, if we do get a negative GDP number tomorrow, we've got 2 quarters of negative GDP, and that will be ballyhooed as, oh, we are in a recession. A recession is when people lose their jobs. People, as long as they have jobs, and still there's a tremendous amount of jobs available there, it is a recession for people who own assets like stocks and real estate. Those prices have come down in the last 6 months, but the real economy, which is jobs, is still at close to a 50-year low unemployment rates. When the unemployment rate starts to go up, that's when people get nervous. That's when people say, wait a minute, I can't go out and buy this stuff on my credit card. I better be careful on my spending. We have not seen that yet. The Fed says they do want to see unemployment going up, and that's what they're going to keep the pressure on the brake pedal on the economy by raising interest rates. I think they're going to continue to do that. Expectation for the September meeting is, again, that they could raise interest rates by 0.50. That's the hope. If they're raised by 0.75%, like they've done the last two times that they've met, that could be a little bit of a problem. I think the market has gotten euphoric that the Fed is done. I don't think so. I think we're going to see some pullback in the market. But as long as we don't get deep pullbacks, and I'll show the charts and talk about that, I think we'll still be okay. Looking at is this a bear market rally? Well, equities rally despite rising rate recession risk. As I've done in the webinars and the seminars that all of you have attended, I've talked about that. The economy continues to slow. Interest rates continue to sometimes go up a little bit, but the stock market takes off. Why does it do that? It anticipates. It's looking 6 months ahead. Market went down for the last 6 months while interest rates were just starting to go up. Economy was just starting to slow, and it has not slowed yet. So the market looks 6 months ahead, and the market will say, well, even though the unemployment is going up, economy is slowing, the Fed is going to take the foot off the brake. And as soon as the market gets a hint of the Fed taking the foot off the brake, the market takes off. And that's why we've rallied from 3,600 to nearly 4,000 in the S&P. And that's what we've seen since the middle of last month. So that's what we've seen. It's not going to be the V shape where we went straight down, came straight up, straight down, straight up. I think this will be a prolonged, it might be a little bit longer as far as the recovery for the stock market. But the stock market, as soon as it sees a hint that we are starting to see inflation peak. Inflation peaks, the Fed does not have to raise interest rates as much. The Fed does not raise rates as fast as they have been. That gives the market more liquidity into the system. That takes the pressure off the stock market also, which always discounts the worst, and that usually does not happen. Far as the U.S. economy is concerned, financial conditions have tightened. You can see that they've come down, not quite all the way where we were during the COVID, but we have tightened quite a bit in the financial, and the Fed will continue to do that, and the financial will continue to tighten. But as I've said on the radio broadcast, I talk about this every day, when the Fed raises rates, it's not an immediate impact on the economy. It takes 3 to 6 months. So the Fed has raised two of the largest increases we've seen in about 20 years. That's what we've seen. That will, to percolate through the economy, will take the next 2 or 3 months. The economy will continue to slow. Both the manufacturing and the non-manufacturing, both indices are starting to come down. As soon as the PMI bottoms, if it gets below 50, that indicates that we are in a contracting situation. If it's above 50, it is still expanding, but we're getting close to 50 now, and we will see if it gets below 50, that'll indicate that we are starting to see a contraction in manufacturing. I think we're already going through that. We'll get the PMI numbers. You hear Tim Fiore, you hear Tony Nieves. Tim is the head of the manufacturing survey at the PMI. He's the chairman of the manufacturing survey committee. Whenever that numbers comes out, we have him on the broadcast, or I have him on the broadcast to give us some idea. PMI is something that I watch very carefully. 4-week jobless claims, they're starting to tick up a little bit, not a lot, but unemployment still at close to a 50-year low. If unemployment starts to go up, that's when we'll see the real brakes being applied to the economy. That's where the economy will slow very quickly. Looking at the technicals, interest rates peaked here. This was the middle of June, and we've seen markets coming down since then. The gap lower in rates, this is going to be somewhere around 3% is the 50-day moving average. This is yield on the 10-year note. It has already in the last month come down. The Fed is raising rates. Why is the market dropping interest rates? The market anticipated it. That's why rates went up dramatically all along here since the beginning of the year. But now they've already started to come down to last month. And they're anticipating that inflation will slow. That means the Fed increases will slow. We will have to wait and see. Don't anticipate. That's one mistake that so many investors make. They want to pick the bottoms and the tops. You don't want to do that in the market. You want to see the bottom in the rear view mirror. Looking in the S&P, as I mentioned, everything moves in 5 waves. This was wave 1, wave 2 to the upside, wave 3 to the downside, wave 4 And then we see a fifth wave bottom right here at 36.36. Since then, we've come back up. We crossed above the 50-day moving average last week. This was the gap at 40.17. We filled that today. The next resistance now will be this number right here, the June high at 41.77. Today we closed at 40.23. Big up day for the S&P, where we gained 100 points for the S&P today. And if we can get above 41.77, I think that is critical. Why? Each one of these lines that you see is 1 day of trading right here. These vertical lines that you see is 1 day of trading. Here, this is a weekly chart. So each one of these lines is 1 week of trading. This was the March low, March of 2020. From there, we went up. We went wave 1, 2, 3, 4, and 5. Once you see the fifth wave top, then we start either an ABC correction. We could have seen that, or we start 5 waves to the upside. If we can get above this number right here, which is 41.25, that I think will indicate that this was the bottom in the market and we're starting to head higher. We might have already done that, but I like to get confirmation before we start putting the cash that we raised over the last 6 months, starting in February, that we raised all this cash. That starts coming back into the market. Looking at the Nasdaq, that's what leads the market usually to the upside. We had a big day in the Nasdaq on the upside today, 4% move in the Nasdaq today. We broke above the 50-day last week. We are now getting close to this high. That's the high that I mentioned in the S&P at 41.77. In the Nasdaq, it's 12,230. We closed at 12,032 today. So we're about 200 points away from that. If we can get above that, then instead of this becoming an ABC move to the upside, it could be 1, 2, and we could be in the third wave. But again, we need confirmation. So we go to a longer term chart. Here, it's a weekly chart. You see this dot plot that I put out. As long as these bars are above these dots and they start turning up in April of 2020, stayed up until the beginning of this year, turned down, and they've been down ever since. This dot plot turns up at 12,811. Now, it comes down every day. The market comes up to 12,811. That to me will indicate that we have made a bottom, and you start looking at the long side and buying the dips instead of looking to raise cash and raise. So this is the 200-week moving average, which is 10,900. This was the 1226 number that I mentioned on the daily charts as resistance, and also the 20-week exponential moving average. So this is all the technical stuff that I'm looking at, but 12.8 is the number that's going to be critical to watch. If you get above that, that'll indicate that the bear market is over, at least from a technical perspective. September and October, usually not good months for the market. September is usually the worst month. So we could see some more volatility. We saw a tremendous amount of euphoria today. 4% move for the Nasdaq in 1 day today. So we saw a lot of euphoria, just like we saw a lot of angst a couple of weeks ago when the CPI came out. I think the market has to go some more backing and filling. Those will be opportunities where you can start to pick up some good stocks that are 40, 50% down. We've seen the froth out of the market. We've seen all the nervous nillies being pushed out of the market. People who were traders have lost their money, or they're stuck in a trade where they've lost a tremendous amount and now they've just given up. So we've taken a lot of froth out of the market. You had a balanced portfolio, you've done well, and you continue to hold on to your portfolio, start adding some of that cash once we do get a confirmation. Crude oil trading between the 200-day moving average and the 50-day moving average, which is 106. This is 94. We closed today at 98. I think if the economy starts to stabilize, then oil will trade between 90 and 110 or so, go back and forth, depending on what happens in Ukraine, what happens. I still feel the global economies are going to continue to slow, as the IMF said, that we could have a global recession. I think Europe is going to suffer a lot more because of the dependency on Russia and the policy mistakes they made over the last 20 years, being all dependent on Russian oil and natural gas. That's those market meters still 50-50 right now as far as the recession goes. But I think I would like to bring this down to about 45 now, looking at the Fed. But I would like to see the inflation numbers for August and September and the unemployment numbers before we can say that the Fed is going to take off the brakes and inflation has peaked. So with that, the jury is still out on that. The outlook for the week ahead, I think we're going to do, we are having a great week this week in the markets. We're going to do some backing and filling, but this is opportunities where you start to look to put some of that cash back to work. Those are my views. Those are my thoughts as of July 27th. I will be back with you next week. Again, if you need help with your portfolio, go to compak.com, compak.com. We'll do a free analysis for you, show you what your risk number is, how do you develop a plan for the next 5, 10, 15 years to get from where you are now to where you want to go financially. Instead of chasing this and chasing that and trying to buy this, you have to have a stable plan and be able to execute it. If you want to do that, go to compak.com or give us a call and we'll be more than happy to help. Have a wonderful week. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moez Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.